All right, hello. We are live in the VIP group for Empowered Women of Chicago.
Hi, everyone. Glad you're here this evening. We have a great speaker in Marla. Many of you know Marla.
And so I know we have a limited period of time today, so we're just going to give a minute or two for people to jump on and then just jump right in and get started.
Yeah, and let me just share that in this quick minute or two, Purse Strings is doing kind of a takeover with the VIP group here, and we want to give thanks to Liz for allowing us to do that. And what Purse Strings is we are an organization of which I'm the founder and Maggie's my partner, and we provide free online tools and resources for women at pursestrings.co, where you can come and get free tools and resources to help you make great financial decisions for yourself and for your families. And we also have a cadre, a list of top-tier financial professionals, of which Marla is one of them. You'll meet many of them all week, who are Purse Strings approved. That means they've been trained and vetted by Purse Strings to serve a female market. So our goal is to get in front of as many women or groups of women to let you know that our service is out there, free to you. We never charge for any of this content, for any of our courses, for any of our tools. They're always free for you online. So that's Purse Strings. Again, come to pursestrings.co for free resources and to look at our list of top-tier financial professionals, of which Marla is one of them, and always work with a Purse Strings approved professional.
Alrighty, I'm going to wait just a couple more seconds before we give Marla's introduction because I see a couple more people popping on. I know we're just hitting 8 o'clock right now.
7 o'clock in Chicago.
Oh, yeah. Sorry, I'm not there right now.
Yeah, and they can just jump in with questions at any point during the session, and Maggie will gather them, and Marla will answer them.
And Marla, where are you in the city of Chicago?
My office is on the near north side, but we serve the entire city, the whole state. We have clients out of state. We've been growing that. We did a lot of deals in Texas this year. That area is very a hot market.
Wow, interesting.
Awesome. So let me give Marla's introduction. Marla Barch has been consistently ranked as one of the top mortgage loan originators in the Chicagoland area. Her expertise with unique loan programs and creative loan structure, her commitment to top-notch customer service, and her diligent effort to make sure every client is matched with the loan program that best meets their qualifications and their goals that sets her apart in the industry. So, Marla, I'm going to turn it over to you.
Thanks, Maggie. Hey, everyone in the VIP group. Glad to see all of you. I'm happy to kick off Money Week. Such an important topic. Money drives so many areas of our life, and especially as women, it's important that we empower ourselves with knowledge. So today we're kicking off with talking about credit. And credit, to me, is a foundational tool for all the other topics you'll hear on the other days, whether we're talking about debt management, buying a home, retirement planning. Credit impacts everything. So it's good that it's the first one here to really set that foundation to help you build wealth and reach your financial goals. I am going to share screen here if I can do this correctly. Okay. All right. So let's talk about credit building. So as Maggie said, my background is as a mortgage loan officer. So credit is not my full-time job, but obviously in qualifying for mortgages, credit is a big piece. So that's why I've built out my education and my tools on that to help my clients build credit for the purpose of buying a house. Now, of course, building credit can be used for a number of other tools as well. So why do you want to build credit? So one main reason is to save money. If you have a better credit score, you're going to qualify for lower interest rates for everything you do, whether it's car loans, mortgages, credit cards. You get better interest rates if you have a higher credit score. So that will help you save money, lower your debt, have extra money to save and invest. And then it also opens up more opportunities. Certain things you actually need a higher score to do. So for instance, buying a home is very hard to do if your credit score is particularly low. So if you're not able to buy a home, you're missing out on that opportunity to build wealth, build equity, pay down your mortgage. And that is, for most people, the biggest source of building wealth throughout their life. So yeah, having good credit score helps you save money and build wealth. And I always look at credit like a chess game. If someone put a game of chess in front of you and didn't tell you the rules, there would be very little chance you would win. So credit is the same. A lot of people don't know the rules. They didn't learn it in school. They didn't learn it from family. But somehow we're expected to all have amazing credit. And obviously there's a lot of factors that affect your credit, and most people do not have perfect credit. We all go through ups and downs in life. So if we know the rules of the game, at least we could be on a playing field where we can at least participate in the game. So credit is not always intuitive. A lot of people have an idea of what they think will make their credit score high, and it's not always accurate. So before you take action, make sure you're getting correct information. I've had clients think things like, oh, if I pay off all of my loans or pay off all my credit cards and close them, my score will go up. And it's the exact opposite. So just make sure when you're taking actions that you are researching it and talking to professionals to make sure that you're getting the right advice and you'll get the results that you want. So the most important thing about your credit is the open and active accounts. When people think about their challenges with credit, often they think about collections, late payments, things that are harming their score. But the truth is that 60% of your credit score is based on the open and active accounts. Only 40% is influenced by those other items. So we're going to start focusing on this because this is the part that, again, is most influential on your score. Okay, so how many accounts should you have open? There are 3 different credit bureaus, and they all have slightly different scoring models, but roughly they all like at least roughly around 3 to 5 open and active accounts. If you have more than that, that's fine. Do not close accounts. Closing accounts hurt your score. But if you have less than that, you will want to build up some additional accounts so that you have at least in that 3 to 5 range of open and active accounts. If you need to set up some new accounts, you want to try to target the ones that you know are more lenient for people building credit. There are certain companies that only want people who have fantastic credit scores and other companies that are fine with people building their credit. So some of the ones that I know are fine with people building credit, Capital One, some of your store cards like Target, Walmart, those are more lenient. There are some websites that compile these lists. So for instance, Credit Karma and NerdWallet, both of those websites, you have to complete information to enter the website, which will pull you, it'll do a soft pull on your credit score. So not a hard pull, but it will pull your credit score. So what it does is when you click on that you're looking for a credit card or a loan, it will match you with the companies that are accessible based on your credit score because it knows your credit score. So those are good tools to match you with the right companies that will allow you, that will give you credit and allow you to set up new accounts. If your score is particularly low, you may have to start with what's called secured credit cards. And those are fine. They report to the credit bureaus just like any other account, and they will help build your credit score. Just be careful of those because a lot of them have these unnecessary annual fees, monthly fees. So shop around to make sure you're not wasting money on fees. One other option to set up, to use new accounts to build your credit, and this one you have to be especially careful with, is if you have a family member or close friend you trust that has good credit, they can take a credit card that's, again, in perfect standing, never had any late payments, has a good credit limit, isn't maxed out, and they can add you as an authorized user. And by doing that, that account will appear on your credit report as if it's yours. So you'll get the full benefit as if you've had that perfect account for years. But again, you have to be careful because if they miss a payment or max it out, that will conversely negatively impact your score. And I've tried all these techniques out on my own credit, so I know that they work. Specifically with the authorized user one, I did that one with my son. He was college student, had no established credit. I put him as an authorized user on 3 of my credit cards, and instantly within weeks, his score was higher than mine, in the high 7s. So authorized user accounts work, but again, just be really careful that it's someone you trust that's not going to damage your score. And you can let them know that they don't need to give you the credit card or the account. It's not to spend money. It's just to appear on your credit report to help boost your credit score. The next thing that's important is how long the accounts have been open. So the longer the accounts have been open, the better it is. So this is why if you do have accounts that have been open a long time, you don't want to close them. Closing accounts will reduce the average number of years that you've had accounts open. And then also, as far as opening new accounts, we want to open accounts to get to that 3 to 5 range where you have enough open and active credit that will build your score. But if you constantly are opening too many accounts, the new accounts only have a 1, 2, 3 month history, and now your average length of your accounts is shorter. So you want to get to the right number, but then stop. You don't want to constantly be opening cards. And I know that's tricky because you're always getting advertisements, or you're at the checkout and they'll give you 10% off. But you want to think about the benefits of your long-term credit rather than that immediate savings, because you'll save more over time by taking the right actions to build your credit. The type of accounts. There are different types of accounts, and what the credit bureaus like to see is a mix of different types of accounts. They want to see that you can handle different things. So for instance, a car loan. That's the same payment every month, and it's due on the same day every month. So that's one type of loan called an installment loan, where you have the same payment due every month. Another type is like credit cards. For instance, credit cards, you could borrow money, pay it back, borrow money again, pay it back. That's called revolving, where you could borrow money and pay it back. So that requires a different financial skill set, because your monthly payments may be different. They'll vary based on whether you spent money that month, how much you spent that month. And so they want to just see that you can handle different types of accounts. So they ideally like a mix of different types of accounts. They do put a stronger emphasis on credit cards, though, because that they look at as harder to manage. It takes more responsibility and more maturity to manage a credit card where it's variable. And so they do put a lot more stress on that when calculating your credit score. Okay, so let's talk about how to handle your accounts. So obviously the most important thing is that all your payments are on time. With technology now, there are ways to automate your payments, whether it be through the company that you have the account with, whether it be through your own bank. There are different tools and apps that can remind you, calendars, reminders, all sorts of things. So whatever system you're using, make sure to have the payments on time. That's really damaging to your score if there are late payments. And the more recent the late payments are, the worse it is. So if you had a late payment back in 2015, it's probably not doing that much damage now. But if you had one 2 months ago, it's going to hurt your score a lot more. So that's number one. The second is how to handle revolving accounts. So again, those are like credit cards, lines of credit. And again, the credit bureaus put a very strong emphasis on that. So the first thing they like is a low utilization. So the utilization is basically what is your balance in relation to the credit limit. So let's say you have a $500 balance and your credit limit is $1,000. You are using half or 50% of your credit limit. So the higher that is, the worse your score would be. You're probably familiar with the term maxed out. So if your balance is 80 or 90 or 95% of the credit limit, in that same example, if you had a credit limit of $1,000 and the balance was $950, you're at 95% utilization. That's what's considered maxed out. And that is incredibly damaging to your score. The credit bureaus hate that. They think it means that you're irresponsible, that you're not managing your money well, and why would you need to spend your full available credit? So we want to stay away from that. So there's a couple of ways to reduce your utilization if you do have accounts that have high utilization. So one way that you can reduce your utilization without actually spending money, because obviously the obvious way would be to pay down the credit cards. But there are ways to reduce your utilization without spending money. So one is to increase the credit limit. So in that same example where we started out, where the credit limit was $1,000 and the balance was $500, your utilization is at 50%. Now, let's say you call the credit card company and ask them to increase your credit limit, and all of a sudden your credit limit jumps up to $5,000 instead of $1,000. Now your same $500 balance, without making any payments to pay it down, $500 balance is only 10% of a $5,000 credit limit. So if you think you can qualify for credit limit increases, which we'll talk about in a minute, that is a great tool to reduce your utilization, is to increase the credit limits. The other thing you could do is shift the debt to a more favorable type of debt. So the credit bureaus do not like maxed out credit cards, but they have no problem with loans. So if you have $1,000 credit card balance, and you open a $1,000 loan and pay off the credit card balance, you still have $1,000 of debt. You have not reduced your debt at all, but you have put the debt in a loan rather than a credit card, and the credit bureaus love that. Your score will go up a lot just from shifting the debt to a more favorable type of debt and not having a maxed out credit card. Similarly, you can do that same trick with retirement accounts. A lot of people have 401k accounts and other similar retirement accounts that you can take a loan against. And so if you take a loan against your retirement account and use that to pay down a credit card, it serves the same purpose. Often the interest rates on the retirement loans are lower than the interest rates on just a personal loan. If you are going to look into personal loans to open a personal loan to pay off some credit card debt, you can again use those same websites I mentioned before, like Credit Karma and NerdWallet. And I don't get paid by them. I just like that they compile all the information in one spot and match it specific to your credit score. And they can show you what companies you may qualify for, what are the interest rates, what the monthly payment might be, and then you can compare and make some decisions. Sometimes you can actually also use that as a stepping stone and have a third step. So if your credit cards are maxed out, your credit score may not be strong. So you open up a loan, use the loan to pay off the credit cards, now your credit score jumps up. However, when you took the loan, your credit score wasn't that strong because you had maxed out credit cards. So you take the loan, I hope I'm not losing you here, there's multiple steps. You take the loan, that increases your credit score, and then you can take another loan to pay off the first loan, because by then your credit score is higher and you'll qualify for better rates. So you won't have the high interest rate and you'll be able to save money. All of these actions that you can take, you can track on free services. So whether it's Credit Karma or there's several other free services out there, you can track your progress. You can look at it once a week or every other week, whatever your schedule is, so you can stay on top of your action plan and what the results are to make sure that you're headed in the right direction and staying on top of it. Inquiries. A lot of people are really afraid of credit inquiries, and they have a bad reputation that they hurt your credit score. And that can be true. If you have your credit pulled, again, a hard inquiry, not a soft inquiry, more than 4 or 5 times in a year, it may knock your score down a little bit. Typically, it's 1 or 2 points, maybe 3 or 4, typically not more than that. So yes, it can damage your score a little bit, but it's minimal. And for the purpose of building credit, you will need to have some credit inquiries, whether you're opening new accounts, requesting credit limit increases, opening a loan to shift your credit card debt. All of those things require credit inquiries. So it's not bad to have a credit inquiry if you're making a calculated risk that the odds of having success with whatever the thing you're focusing on is good, so you'll gain more points than you may lose with the credit inquiry. So you want to make that educated guess. So if your credit score is in the 500s, chances are your current credit cards are not going to increase your credit limits. So you don't want to just waste a credit inquiry if you don't think the odds of success are good. Okay, so that is the open and active part of your account, which again, 60% of your score is based on those open and active accounts. So that is really the most important part to focus on and track it and make sure you're staying on top of keeping that strong. Now let's talk a little bit about your closed and negative accounts. So a lot of people are afraid of this. They don't like it. They just want to stick their head in the sand and not deal with it. And with credit, sticking your head in the sand doesn't typically get the results that you want. So, and also, as a side note, a lot of people have shame around credit. They feel like they did something wrong, or they were bad, or they're not, they're not worthy. And none of that is true. We all have financial hardships. I mean, there's a lot of things, external factors in the world that are totally not our fault. There was the recession. People have gone through divorces. People have had medical conditions, and you get all these medical bills. So totally not your fault. It's very common for people to struggle with credit. Even people who make good money are very responsible. So don't feel bad about this. It's just important to educate yourself and move on to improve the situation. So the first part of the negative part of your credit is public record things. So legal action. So you've got judgments, bankruptcy, short sales, foreclosures. Again, these are all things that happen. No need to feel bad about it. They're going to be on your credit report for a period of time. There's a law, and I'm not an attorney, so I don't know the technicality of it, but it's called the statute of limitations. So every state has a statute of limitations for different types of accounts where after that period of time, it will fall off your credit report. So none of this damage is permanent. You just wait that period of time, they will fall off. I have heard some people say they've been able to dispute bankruptcies and get them off. I don't personally understand how that works, but if you want to look into it, I've heard people say that. But these things just are a matter of fact. Now, if you have judgments with outstanding balances, you'll want to get those resolved. And there's different ways to resolve it. If it's a small amount, you could just pay it. If it's a larger amount, it may be worth hiring an attorney to negotiate it down. Typically, they can negotiate larger debts down to maybe 10 to 20% of the balance. So if you have a $10,000 judgment, they may be able to get it to 10 to like $1,000 or $2,000. So if you have a lot of judgments, you may want to consult an attorney. And there are attorneys that specialize in that, and if you want that, I can connect you with some as well if you don't know any. So if you have judgments, I would get those resolved. But otherwise, legal issues just are what they are, and you have to wait for them to fall off. But again, if you're focusing on the open and active accounts, your score will go up regardless of this. I've seen people a year out of bankruptcy with scores in the 700s. This is not, a death sentence for your credit score. Okay, then there's other negative items: collections, charge-off, repossessions, late payments, unpaid income taxes, unpaid child support, and sometimes some other things. So all of these items, again, are having some impact on your score. About 40% of your score is based on these type of accounts. So again, these also have the statute of limitations, typically 7 to 10 years, depending what state the company is in that has the debt. So the statute of limitations, some of that will eventually fall off. For items that you want to clean up quicker, there's two possible things that you could do. One is you could get them removed from your credit report. And that is going to have the strongest results, because getting it removed is like if it never happened, okay? So it actually completely disappears as if it didn't happen. So there are different ways that you can dispute accounts if they're not accurate, or even if they did happen, but there's something inaccurate about how they're reporting it. You can hire companies to do this. You can look up online templates, try to do it yourself. There's all sorts of tools available for that. Some people say that sending a dispute letter handwritten in the mail is better than doing it online disputing. There's a lot of different information about that if you want to try to get negative items off your credit report. So that is the first option. If you're not able to get the account off your credit report, it will help if it at least shows a zero balance. So usually, like, let's say there's a collection that has a $500 balance. Again, if you can dispute it, if there's something inaccurate about it, you can get it off as if it never happened. That's best. But if you can't, if you can at least get it to zero balance, that will help your score a little bit. It's not a huge game changer, but eventually, if you have multiple accounts, they all get to zero, you will see your score go up some. But the things we were talking about before, as far as maxed out credit cards, those are things that will help your score a lot more than paying a collection. A lot of people are surprised that they get all their collections down to zero balance and their score doesn't go up a ton. It will go up some. And again, the way it gets to zero balance doesn't matter as much, whether you pay it in full, whether you negotiate with them and settle for less than owed. It may help your score a little bit more if it's paid in full, but I haven't honestly noticed much of a difference. As long as it gets to zero balance, that's really the important part of that. And again, you can hire companies to do it. There are tons of companies out there to do it. Or you can work on it yourself. The other thing you can do sometimes is you can dispute it with the original company, not with the credit bureaus. So if it was with like a gas bill or, an internet bill or something like that, you can call those companies. And if they agree that it's not accurate, they will tell the collection company to take it off. So you can either work with the company or the credit bureaus. If you're going to work with the credit bureaus, know that there are 3 credit bureaus, and these negative accounts can report to all 3. Sometimes they don't. Sometimes it's just 1. Sometimes it's 2. Sometimes it's all 3. If it's on all 3, you do have to dispute with all 3 to get it off. If you get it off just 1, it's not going to have the full result that you want. So those are negative items that, again, 40% of your score. If you want to work on improving them, you can. But just to clarify, these things, this is what, when you hear people talk about credit repair, this is what they're talking about. Credit building that we talked about in the beginning that is really more impactful on your score is something that a lot of credit repair companies don't offer. I've seen people spend thousands of dollars on credit repair and come out and their scores are still in the 500s because nobody told them they needed to set up new accounts and build those positive accounts. So make sure, even if you're working on this, that you're focusing on building the positive part of your account, setting up those accounts. One thing I forgot to mention earlier is credit limits. The higher your credit limit is on credit cards, the better. You can request those as often as you want, every 3 months if you want. Try to keep getting those higher. The credit bureaus really like you to have a lot of available credit. They think that shows that you're responsible if credit card companies are giving you available credit. Okay, so next steps is what I would say is put together a personal action plan. If certain things here resonated with you, you said, oh, I only have 1 open account, I don't have any open accounts, I have maxed out credit cards. Whatever things resonated with your situation, put together a plan, write it on paper. If you write it down, you're more likely to be successful. Itemize the steps that you plan to do and what sequence and what time goal, and then use a system like Credit Karma to track it. So if you have a goal like, okay, every Sunday is my day to check in on this and hold myself accountable. So every Sunday you could pull up your Credit Karma, say, what is my score today? What progress have I made since the last time I looked at it? And what are the next actions I need to take for this upcoming week? You can focus on building those. And again, if there's information you're not sure about, make sure to get the right information, because again, sometimes it's not intuitive. What you think might help your score may not be exactly the right actions. So that is my presentation. I believe there is an option for questions if anyone has any specific questions.
Marla, that was fantastic information. Everything everybody needs to know about credit, just all in 28 minutes. It was amazing.
Perfect timing. Yeah, you hit on some questions that even I had. I always thought that whole idea of if you checked on your credit too often, you got dinged and things like that. I didn't know if that was old or if that was just not really true.
Right. So there's also the distinction between soft inquiries and hard inquiries. If you're looking at your own Credit Karma, that's a soft inquiry. That will never go against you. And some companies do soft inquiries. For instance, Capital One, if you're asking for credit limit increases, they do soft inquiries. So that will not go against you. So it's only the hard inquiries that can go against you, again, if you have too many and a few points. So again, it's a calculated guess. If you think you're going to gain 30 points from taking a certain action and you may lose 1 or 2, it's probably a good gamble.
Can I ask a question about the actual credit score? Is 800 the highest level?
So there are different credit scoring models. And when you look at your score online, you may see different numbers. If you look at Credit Karma versus Equifax, you're not going to see the same number. And there's different reasons for that. So the common model that we use in the mortgage industry goes up to 850. There's other ones, though, that have different scoring models, but they're all pretty similar.
So where would you want your credit to be around?
Well, the higher it is, the better, the better the deals you're going to get when you're using credit. So if you're, at or above 800, you're going to get the absolute best interest rates and terms. 700s are also great. Nothing wrong with the 700. 600s are fine. You're going to qualify, but you're not going to qualify for the best rates. So you definitely want to improve. And 500 is, a lot of things you won't qualify for. And if you do, you're going to get really, really terrible rates.
Got it.
Michelle has a question for us, and she asked, if someone is interested in qualifying for a mortgage, can you help them repair their credit if needed?
So I do some of that. So my primary job is to get people mortgages. But if people come to me and they want to buy a house and their credit score is not where they need to be to qualify, I will give them tips and lay out a plan of action for them of what things they can do to get to that goal of homeownership.
Yeah, she was saying, meaning, can you help them put together a plan, which sounds like exactly what you do. If they can't get a home now, you're going to make it happen.
But I don't do like credit repair. So I'm not going to sit there and write the letters to dispute, your accounts for you, things like that. But I will give you a plan and tell you what things you need to do to get to that goal.
That's awesome. That's great information. Let me see if any more questions come in the next couple minutes. I was wondering if you could say a little bit more about what a hard pull versus a soft pull is, kind of the number difference.
Well, soft pull doesn't affect your score at all. So there's no penalty for that at all. You can do as many soft pulls as you want. But if you're talking to a company and saying, hey, can you increase my credit limit? Ask them, are you going to do a soft pull or a hard pull? So you know if it's a gamble or not.
And how many points would be a hard pull, ish?
Also, if you've had less than 4 or 5 hard pulls in the past year, you shouldn't see any damage at all. If you've had more than that, you may see a point or two. Sometimes the maximum I've seen is 3 or 4 points. Usually it's 1 or 2 points. It's usually pretty minimal.
Awesome. We have another who asked, spill the tea on the balance transfer versus alternative loans to avoid interest. Mine are at 14%, and it seems difficult to find a better rate.
Yeah. So the interesting thing is that the answer for what's best for your debt is not always the same thing that's best for your credit. So if you have a balance transfer offer that's going to be 0% interest rate, that's great for your debt because you're saving a ton of interest that you otherwise would have paid. But if you're maxing out that card to take advantage of the highest amount you can get on the balance transfer, that's still going to be bad for your credit score because you still have a maxed out credit card. So those are the factors to balance. And I would look at that in light of what things do you have coming up in the next year that you need to use your credit for. Are you planning to buy a car? Are you planning to buy a house? Then you want to be conscientious of how it's affecting your credit score. If you have no plans to do anything major with your credit, then take advantage of the low interest rate, and that's fine, but just be aware that when you want to take an action, you'll want to get your credit score back up because it will take a hit with that.
All right. And then I think we have one more question for you. And that would be, how fast do you see the results of your credit score being affected? If I call up right now and extend my credit limit, when will I see my points go up or down?
So you will see the results the next time that account reports to your credit report, and they typically report on the statement date. So the statement date is not the day it's due, it's the statement actually ends and closes and they package it up and mail it off to you. So if you look at your statements, it usually will say end date, cycle date, statement date, something like that. And that's the day they report to the credit bureaus and they report what is the balance on that day. And then sometimes it takes a day or two to process. So 2 days after that statement date, if you look at your Credit Karma, you should see that account report. So it can be very immediate. If you had a maxed out credit card, you shifted the debt to a loan, and it reports in 1 week from today, you should see that result pretty quickly. And again, paying down credit cards, whether you're actually paying them or just shifting to something else, that can be a lot of points. I've seen people get close to 100 points just from getting rid of maxed out credit cards. Not always going to get that many points. Sometimes it's 30, 40. It depends on a lot of factors, but you will see that result immediately. That's not a slow one. Some of the other things, like if you have a late payment, the longer you get away from that, you know, your score will go up a little bit, but that's something that would take time. But something like paying down credit cards or credit limit increase, you'll see that immediately.
Awesome. Well, I think that's it for this evening. Thank you so much, Marla. Thank you, Liz, for hosting us today or tonight. And we'll be back here tomorrow for another fun financial educational session. So thank you again, Marla.
What's the topic for tomorrow? What are we going to learn about tomorrow?
Well, you're putting me on the spot, aren't you? Let me see. 1 second. Tomorrow we have how to create a workable spending plan.
Budgets are important. And
we're not calling it the B word.
One other quick note, on Saturday, we're doing a home buying workshop. So if you are interested in buying a home, we are focusing specifically on that Saturday at 11, right here in the VIP group. So join us for that, as well as all week long, every night this week, 7 p.m., all the different presentations on financial topics.
And Saturday, how long is that going to be? A longer session?
Yes. I don't know exactly how long, but more than half an hour.
Okay, awesome. I just want to have our viewers prepared. Awesome. Well, good night. Thank you, everyone.
Good night. Thanks, Marla.
Bye.